People always assume real estate shifts with loud warning signs, crashing charts, frantic headlines, panic in the streets. But Montreal doesn't move like that. It shifts quietly, almost like a tide pulling back before anyone notices the sand changing beneath their feet. Investors aren't fleeing the city, but they are retreating from certain districts, and the reasons aren't obvious at first glance. Some neighborhoods are cooling because of silent forces like rental stagnation, hidden maintenance traps, or demographic currents you only notice if you've been tracking the city for years. Others are slowing because the psychology of investing has changed. Confidence bends long before prices do. And when all these subtle pressures line up, they reveal a map of Montreal that looks completely different from the one most people think they know. This countdown breaks down why each district holds its position, and what investors should keep their eyes on moving forward. Pointe-Claire. Pointe-Claire holds the 10th spot because its slowdown is subtle but consistent. Investors used to rely on this district for predictable rents, long-term tenants, and steady appreciation. But rising interest rates pushed mortgage payments higher, and rental growth didn't keep pace. Searchable market data shows longer listing times and fewer multiple offer situations compared to pre-2023 levels. Investors are calculating thinner margins, especially on mid-priced duplexes that once delivered comfortable cash flow. Future watch. Keep an eye on rate cuts, West Island job growth, and infrastructure updates. If borrowing costs ease or new employers move in, demand could stabilize and investor confidence may return faster than expected. 9. Ahuntsic-Cartierville. Ahuntsic-Cartierville sits at number 9 because many of its investment properties are aging, and renovating them has become expensive. Investors looking through listings frequently see buildings marked needs upgrades, with roofs, plumbing, and electrical systems requiring serious work. With higher carrying costs and stricter lending rules, the return on these older multiplexes isn't as appealing. Rent increases haven't matched the rising costs of maintenance, which further weakens the investment case. Future watch. Pay attention to potential renovation grants, demographic shifts, and long-term rental demand from growing families. Any support for upgrading older buildings could significantly improve investor sentiment. 8. Côte-des-Neiges/NDG. Seton-NDG lands at number 8 because investor enthusiasm has cooled in student-heavy pockets. The area still pulls renters, but turnover rates remain high, and vacancy periods have lengthened according to recent rental trends. Maintenance on older triplexes keeps rising, and landlords dealing with frequent tenant changes face higher wear-and-tear costs. Cash flow that once looked stable now requires more careful forecasting. Future watch. Monitor university enrollment trends and housing demand from international students. A rebound in that population could tighten vacancies quickly. Also watch city-level decisions affecting multi-unit housing density. 7. Rosemont, La Petite Patrie. Rosemont takes the 7th spot because it shifted from a growth district to a priced-in district. Over the past few years, values rose sharply while rents increased at a slower pace. Searchable market data shows compressed cap rates and fewer value opportunities for new investors. Those who didn't buy early now face higher entry costs with limited room for strong monthly returns. Future watch. Watch for zoning changes, especially around mid-density housing. If development rules loosen or new projects add supply, pricing pressure could ease and restore investor interest. 6. Plateau. The plateau sits at number 6 because charm alone isn't enough to offset the numbers. Investors face rising property taxes, costly repairs on century-old architecture, and saturated rental competition. Listings show more seasonal vacancies, and some units take longer to fill than before. The district's walkability and culture remain strong, but financial performance no longer matches its reputation. Future watch. Pay attention to heritage building incentives, potential tax adjustments, and tourism rules. Even small policy changes could improve the profitability of furnished or midterm rentals. 5. Ville-Marie reaches 5th place due to a major shift in downtown rental dynamics. Tighter regulations hit short-term rentals hard, pushing many units into the long-term pool. This increased supply, slowed lease-ups, and created more competition among landlords. Condo fees stayed high while rent growth cooled, squeezing investor margins. Searchable MLS data shows longer selling periods and more price adjustments. Future Watch. Track changes to short-term rental laws and downtown office to residential conversions. Both could influence demand, supply pressure, and rental strength in the core. For Griffintown. Griffintown ranks fourth because it moved from booming to oversupplied. 4 years it attracted aggressive pre-construction investors, creating a wave of new units hitting the market at the same time. Developer incentives and high inventory levels now show that demand isn't keeping up with supply. Rental rates have flattened, and resale condos face heavy competition. Future Watch. Watch vacancy rate shifts and downtown job growth. If more young professionals move back into the core, Griffintown could rebound quickly. A slowdown in new construction would also rebalance the market. 3. Hochelaga-Maisonneuve, Homa. Homa sits in third because rising renovation costs and strict tenant rules increased investor risk. Many properties here are older, and bringing them up to code requires significant capital. Searchable data shows fewer multiplex transactions and more cautious investor behavior. Regulations around tenant protections make rent adjustments slower, which affects cash flow on buildings needing upgrades. Future Watch. Keep an eye on municipal housing policy, especially around renovations and tenant-landlord rules. Any easing could lift investor confidence. Watch neighborhood revitalization projects as well. They drive long-term value. Verdun lands at number 2 because its rapid price escalation created a mismatch with rental income. Investors who once loved its affordability now hesitate because returns don't justify current price levels. Searchable records show longer listing periods and fewer bidding wars compared to the pandemic peak. Rental demand is healthy, but not strong enough to offset higher financing costs. Future Watch. Watch for price corrections and new infrastructure announcements. Verdun tends to benefit from transit improvements and waterfront upgrades, which could spark renewed investor interest. 1. Downtown Core, Shaughnessy Village/Renée-Lévesque Corridor. The downtown core takes the number 1 spot because it faces the heaviest combination of pressures: large condo supply, higher interest payments, slower rental growth, and strict short-term rental enforcement. MLS data shows units staying on the market significantly longer than they used to. Investors face intense competition, and turnover on smaller units cuts into profitability. Future Watch. Key signals include construction slowdowns, immigration increases, and changes to short-term rental regulations. Any one of these could reshape demand and revive investor confidence in the core.